Welcome to the deep dive. Today we're getting into something really important, maybe a bit uncomfortable, but definitely critical for business owners.
That's right. We're talking about what actually happens to your business loans, and maybe more importantly, those personal guarantees you signed if you were to pass away unexpectedly.
It's a heavy topic for sure,
Hmm.
but ignoring it,
Yeah.
that's probably not the best strategy.
No, definitely
Huh.
not.
Hmm.
Not understanding this stuff can cause huge problems for your family, financially, and even threaten the business itself.
Absolutely. So
Mhm.
we've looked at a range of sources to really unpack this. We're going to explore what happens to the debt, who might get stuck with it, and what practical things you can actually do now to prepare.
Yeah, because that personal guarantee, the one you signed thinking the business would always cover it,
Yeah.
that could potentially put major family assets, maybe even the family home, really on the line.
Oof. Okay.
So our goal here, our mission for this deep dive, isn't just to point out the problem. We want to give you real clarity, actionable information so you can tackle this proactively.
Okay, let's dive in. The big fundamental question first. When a business owner dies, what actually happens to their business loans? They don't just disappear, do they?
No, unfortunately not. The debt itself, it remains. It's still an obligation. And a really key piece here is that personal guarantee we mentioned.
Explain that a bit more.
Well, when you sign one, you're essentially telling the lender, look, if the business can't pay this loan back, I personally promise I will.
Okay.
And that promise, it doesn't just end when you die, it extends to your estate.
Your estate, so like everything you own when you pass away.
Exactly. Your house, your savings, investments, whatever assets make up your estate, the lender can legally pursue your estate to get the loan money back.
So even after someone's gone, the bank can still come knocking on the door of, well, their estate.
Yes, that's a very real possibility. Our sources are quite clear on this. They have the right to try and recover that outstanding loan balance from the assets left behind.
And that could mean personal assets, things like the family home you mentioned, or maybe other property.
Absolutely. Especially if those specific assets were pledged as security, as collateral for the loan in the first place.
Like if you put your house up against the loan.
Precisely. In that case, the bank has a clear legal path to seize that asset, the house or whatever it was, and sell it to pay off the debt. It's a serious vulnerability.
Wow. Okay, what if other people are involved? Like say there was a co-borrower or maybe someone else signed a guarantee too.
Good question. That adds another layer. In those cases, the responsibility often shifts. And this is where a concept called joint and several liability really comes into play.
Joint and several liability. What does that mean exactly?
It means that if you both guaranteed the loan, the lender can pursue either one of you or your estates for the entire amount owed, not just 50-50.
That's the whole thing.
The whole thing. So if you co-signed or co-guaranteed, you might suddenly find yourself solely responsible for repaying the entire remaining debt if the other guarantor passes away.
That's a huge potential burden.
It really is. It's something partners often don't fully grasp the implications of when signing.
Okay, so let's recap. The debt survives, the estate is potentially liable, co-guarantors could be on the hook for everything. What happens in the sort of worst case scenario? When neither the business itself nor the estate has the money.
Well, then the bank has to look at other options, and that could mean a forced sale of the business's assets, equipment, inventory, maybe even the building if it's owned.
Trying to get whatever money they can out of it.
Exactly. Or it could even lead to the complete shutdown of the business. One source mentioned the bank's first step is figuring out who's actually in charge now, who's responsible.
Makes sense.
And if there's no clear path to repayment, liquidation might be the only way they see to recover their funds.
That's pretty grim. Does the type of business you have make any difference? Like, does it matter if it's a sole proprietorship versus, say, a corporation?
Oh, absolutely. The legal structure of your business, it definitely impacts how loans are handled after the owner's death. It's not all the same.
Okay, let's break that down then.
Yeah.
What about a sole proprietorship? That's pretty common for small businesses.
Right. With a sole proprietorship, the law basically sees the business and the owner as the same thing. There's no legal separation. So when the owner dies, the business often just ends, legally speaking. And because there's no separation, the owner's personal assets are directly on the line for any business debts.
Okay, so personal assets are the first stop for paying off business loans there.
Hmm.
What about companies, corporations, LLCs? They're separate legal entities, aren't they?
They are, and that separation makes a difference. Because the business is legally distinct from the owner, it can often keep operating even after the owner passes away.
So the loan obligation might stay with the
It
business.
might, or the owner's estate might inherit the ownership stake and the associated responsibilities, or perhaps new owners take over. It really depends on things like succession plans, the company's health, and loan agreements.
And partnerships. They always seem a bit more complex.
They can be. For partnerships, what happens with loans usually comes down to what's written in the partnership agreement.
Ah, the agreement itself.
Yes. A good agreement should spell out exactly how debts and liabilities are handled if a partner dies. Who's responsible? Does the partnership dissolve? Does the surviving partner take it on? It should all be there.
So having a really solid, clear partnership agreement is, well, absolutely crucial then.
Couldn't agree more. Planning ahead, getting those agreements right, it's vital for protecting everyone involved and just making things smoother if the worst happens.
Okay, these structures help understand the how, but maybe we can make it even clearer with some real-world type scenarios. Examples always help things stick.
Good idea. Let's think about a couple. Imagine, let's call him Nathan. He runs a small, successful business as a sole proprietor. He took out a pretty big loan a few years back.
Right.
He signed a personal guarantee, and he even used his family home as collateral to get better terms.
Oh, okay. I see where this might be going.
Right. Sadly, Nathan passes away suddenly. His business, which really relied on him personally, starts to struggle without him. The business income drops. It can't make the loan payments.
So the bank.
The bank eventually looks to that personal guarantee. And because the house was pledged as collateral, Nathan's family is now facing the very real, terrifying possibility of losing their home.
That just really drives home the risk of those personal guarantees, doesn't it?
It absolutely does. Now, think about that partnership situation we mentioned with the joint and several liability.
Yeah.
Say two partners guaranteed a large business loan together. One partner dies unexpectedly. Because of that joint and several clause, the bank could legally require the surviving partner to repay the entire remaining loan balance.
Even the deceased partner's share.
Yes. Even if the business was struggling or the deceased partner was maybe more responsible for that debt, the survivor is potentially on the hook for all of it.
Man, that highlights the need to really understand what you're signing with partners.
Definitely. But it's not always doom and gloom. There are positive examples, too, usually involving planning.
Okay, good. Let's hear one.
All right, imagine Lisa and Tom. They co-own a business, took out a loan, both signed personal guarantees, but crucially, they were advised to take out business loan protection insurance.
Ah, insurance. Okay.
So when one of them unfortunately passed away, the insurance policy kicked in. It paid out enough money to completely clear the outstanding business loan.
So what did that mean for the business and the family?
It meant the business could carry on without that debt burden hanging over it. The surviving partner wasn't suddenly saddled with the full loan, and the deceased partner's family wasn't pursued for the debt either. It protected everyone.
That's a much better outcome. It really shows the power of being prepared.
Exactly. Proactive planning makes all the difference.
Okay, so these examples make it very real. Let's talk specifics then. What protective measures can business owners actually put in place? What are the options?
Well, there are several routes you can explore. One possibility is finding someone else to take over the guarantee.
A replacement guarantor.
Yes. If there's maybe a family member taking over, or a key employee, or a new partner who's willing and financially strong enough, you could approach the bank.
And ask them to swap the guarantee.
Essentially, yes. Ask them to release the original guarantor, or their estate after death, from the obligation, and accept the new person's guarantee instead.
Is that easy to do?
Not always. The bank has to approve the replacement. They'll assess the new guarantor's financial standing. It's definitely not a given, but it's something you could potentially negotiate.
Okay. What else? We mentioned liquidation earlier as a negative outcome, but is selling the business ever a planned strategy here?
It can be, yes. If there's no successor, or if the plan is always to wind down upon the owner's death, then an orderly sale of the business could generate funds to pay off the loan.
But you mentioned forced sales often get less money.
Right. A planned sale, ideally before a crisis hits, is much more likely to achieve fair market value compared to a fire sale conducted by the bank or the estate under pressure.
Makes sense. And then there's the insurance option, like with Lisa and Tom. That seems pretty powerful.
It really can be. Business loan protection insurance is specifically designed for this. It pays out upon the death or often critical disability of the insured owner, providing funds earmarked to pay off the business debt.
So it directly tackles the loan problem.
Yes. Or sometimes a regular personal life insurance policy can work if the payout amount, the death benefit, is large enough to cover the business loans on top of any other family needs.
Well, you need to make sure the coverage is actually sufficient.
Absolutely critical. You need enough to cover everything intended.
Beyond these specific actions, what are some sort of foundational things every owner should do, like basic blocking and tackling?
Good way to put it. Number one is meticulous documentation and planning. Seriously.
What does that involve?
It means creating and keeping up to date a crystal clear record, a written list of every business loan for each loan, who the lender is, the current balance, who personally guaranteed it, and what, if any, specific assets are pledged as collateral.
Get it all down on paper.
Yes. And make sure that paper or digital file is organized and stored somewhere safe but also accessible. Your family or executor needs to be able to find it easily.
And communication.
Huge. You absolutely need to talk about this with your family, with your business partners. Tell them where the documents are, what the plan is. No surprises during a crisis.
Right. Okay, let's dig just a bit deeper into those guarantees again. We've said personal assets are at risk, but can you just reinforce how direct that link is?
It's incredibly direct. When you sign that personal guarantee, you are legally saying, if my business fails to pay, you, the lender, can come after my personal stuff.
It's not just a formality.
Not at all. It's a binding legal commitment. And again, this doesn't just go away if you die. Your estate inherits that liability. The legal responsibility to pay passes on.
And that joint and several liability thing with co-guarantors. It feels so important. Maybe we should hit that one more time.
Definitely worth repeating. Joint and several means each person who signed the guarantee is potentially responsible for 100% of the debt, not just their portion.
So the bank can choose who to chase.
Yes. They can pursue whichever guarantor or their estate seems most likely to have the funds to repay the entire outstanding amount. They don't have to go after everyone equally or proportionally.
Okay. That clarity is sobering, but really necessary.
It is. Understanding the full weight of these guarantees is step one.
All right, this has been a lot of information, but super valuable. Let's shift to making it really practical now. For someone listening thinking, okay, I need to do something, what are the concrete, actionable steps they can take, maybe starting this week?
Okay, first things first. You need to know exactly what you're dealing with. So step one, make that list.
The loan inventory we talked about.
Exactly. Pull together all your loan documents. Create a comprehensive list. Lender, current amount owed, who signed guarantees, what assets are pledged as collateral. Get it all in one place. Know your exposure.
Okay, list done. What's next?
Talk. Initiate those conversations. Sit down with your business partners. Discuss succession openly. What happens if one of you isn't here? Who takes responsibility for the loans? How would it be managed?
And maybe document those conversations.
Ideally, yes. Document any agreements you reach. Perhaps update your partnership or shareholder agreement to reflect the plan. Clarity avoids disputes later.
Good point. So list, talk, then insurance.
Then investigate insurance options seriously. Don't just assume you're covered or that it's too expensive. Get real quotes for life insurance sufficient to cover the loans, or specifically look into business loan protection policies.
Understand the costs and benefits.
Yes. See what the premiums are, what the payout covers, how it fits your overall plan. It might be more affordable or flexible than you think.
And all this paperwork, the list, the agreements, the insurance policies.
Needs to be organized and accessible. Keep copies of everything together. Make sure your spouse, your executor, or a trusted advisor knows exactly where to find these crucial documents if needed. Don't make them hunt for it during a stressful time.
Absolutely. That seems key. Is this a one-and-done task?
Definitely not. This isn't something you set up once and forget about. Businesses change, loans get paid down, or new ones are taken out. Partners might change. Your personal situation evolves.
We'll review it.
Regularly. At least once a year, pull out the plan. Review the loan list, check your insurance coverage levels, reread your agreements, update anything that's changed, keep it current.
That makes sense. Annual financial checkup, but including this aspect.
Precisely.
Okay, let's tackle a few quick questions people might still have based on what we've discussed. Is there any chance the bank might just not bother, not pursue the family or estate?
Look, it's technically possible in some rare circumstances, maybe if the debt is very small or the cost of pursuing it is too high, but you absolutely cannot rely on that hope.
Especially with a guarantee.
Especially with a personal guarantee in place, and if this business can't pay, Banks generally have a duty to recover debts. Assuming they'll just walk away is really risky.
What about existing life insurance? If someone already has a big personal policy, does that automatically cover business loans?
It can work, yes, if the policy's death benefit is genuinely large enough to cover the business loan, plus whatever personal needs the family has, like replacing income, paying off a mortgage, education funds.
But it needs to be enough for everything.
Yes, and crucially, the beneficiaries need to understand that intention. The policy pays out to them, they then need to use it to pay the business debt. It requires careful calculation and clear communication.
We talked about co-sign loans. Just to be
Mhm.
crystal clear, if you co-sign, what's your liability?
Your liability is typically for the full amount. Each cosigner can be held responsible individually for 100% of the outstanding debt. It's not automatically split.
Okay. And finally, can the estate or family just walk away? Say,
Yeah.
sorry, the owner's gone, we're not paying.
Generally, no. Not if there's a personal guarantee. That guarantee creates a legal obligation for the estate. Walking away isn't usually a viable option if there are assets in the estate. The bank will likely pursue legal means to recover the debt from those assets.
It really all comes back to that guarantee being a powerful legal tool for the lender.
It absolutely is. That's why understanding it and planning for it is so critical.
Okay, so let's try and wrap this up, bring it all together. What are the absolute core messages you want our listener to walk away with from this deep dive?
I think there are a few main things. First, business loans don't die with the owner. They live on.
Right.
Second, personal guarantees mean your personal assets or your estate's assets are potentially on the line. It's not just business risk.
Got it.
Third, co-guarantors can be left holding the bag for the entire debt because of joint and several liability.
A crucial point for partners.
And finally, the most important one. Proactive planning is essential. It's not morbid, it's responsible. Insurance, clear documentation, open communication, these things protect everyone.
It really does sound like having that plan is invaluable. It's not just about the business continuing, is it? It's about protecting your family from unexpected financial shocks.
Exactly that. Taking these steps, we've talked about making the list, having the talks, checking insurance, organizing documents. It might feel like work now, but the peace of mind it brings is enormous. It secures the business's future and your family's financial well-being.
So the final thought for you listening,
Yeah.
don't put this off. Take a moment after this, think about your situation. What's the one step you can take this week to start getting your plan in place? Because ultimately, this is about your legacy and the security of the people you care about most. Thanks for joining us for this deep dive.